Hi everyone, I hope we're all well and Happy New Year to everyone if I haven't spoke to you previously. So this week's webinar is to do with, or this month's I should say, webinar is to do with financial freedom. A lot of people at this time of year, they tend to set goals, the majority of those being financial goals. And of course, it's a great time as any to start kicking things off and ensuring that you're setting things up maybe not only for yourself, everyone has different aims and ambitions, but maybe for yourself for latter years when you're retired, maybe for things like kids, grandkids, university funds, anything that you feel is ideal, there's a way to package it. So let's get started. So first of all, why property? Well, what I always say is I've been in the property market for give or take now 13, 14 years. However, prior to that, I was in the stock market. So I started off, as soon as I left university, I started off as a graduate trainee for a stockbroking firm. Now, the thing that always struck me, and this is what I couldn't get my head around, was you had investors, you had amateur investors who maybe they picked up the FT and some of them lesser known papers for stocks and shares and just simply invested on the back of that. We would have calls in from a client and they would go and deposit 40, 50, 60,000 pounds, we're not talking about one or 2,000 here, 40, 50, 60,000 pounds, and their experience would be nothing. They would have no experience. And then when they lost money, they wondered why, they couldn't understand it. They thought, well, shares always went up. But actually what they've done is they've just simply invested on the back of maybe a newspaper report. They've not looked at the fundamentals. When I was in this industry, it was around about 2002, 2003, and 2003. This is when the Iraqi war started, and the stock market hit a low, and people were losing fortunes. And the issue is that people didn't understand. They just simply didn't understand why. And the issue is that anyone that was investing at the time, they actually had a job. So they had a job to do, but they invested in the stock market thinking they just put their money in it and that was it. But it didn't work like that. Every investment that you make, you should consult a professional. The advantage that I find about property and why property is because even though you've got your daily job, you physically don't have time. I mean, these people that would invest, they might look at their shares for 1, 2, 3 weeks on the trot, and that's it. They would kind of forget about it. And it's the times that they forget about it is when they would lose their money. With property, you don't have that problem in the sense that you haven't got something that is so liquid like stocks and shares that it can suddenly drop to zero. Like we saw in the 2008, we had these huge banks, AAA rated banks that were Lehman Brothers going to the wall and going to zero. We haven't had that in the property side of things. So if you become a buy-to-let investor, you can actually do it around your existing career because you don't actually physically need to be hands-on, 24 hours essentially. Again, with the stock market, we had a huge amount of instances in that decade. You take things like 2001, September the 11th, you take the Iraqi war, you take 7/7, which happened in London. And if you're not literally by the phone or by a computer and you can't sell out of your stocks and shares, that's it. You could get there a day late and they've gone down 20, 30%. But because of that, property is a more stable asset. There's also a flip side. There's a negative side to that. The reality of you sort of like making 30, 40% in the space of 6, 7 months, it's not going to happen. Stocks and shares, we've all read about the success stories where someone invested 100,000, turned it into $1 million over the period of a year because of one particular stock went up. Again, we hear about those far too often, in my opinion. The reality is you're not going to do that in property. It won't offer the same a huge growth in a short space of time. But consistently, the type of investors that we deal with are the longer term investors. They're looking to save for a reason. So what we simply say to everyone is medium to longer term, we feel that property is your safer bet. And as we say, you can build it around your day job. So if you've got a day job, that takes up the majority of your time, you can build a business around it. And we handle everything. You don't have to use us, of course, but we handle everything from the actual furniture pack side, the lettings, the management, the whole lot. And we have an after sales team here. We source your property. So everything can be done for you without you having to worry about on a daily basis what's happening with your property. Once purchased, again, it's ideal. The business essentially runs itself. Once you've got clients in, this is if you're doing a typical what's called an AST. That's an assured short hold tenancy. That's where you're letting out for 12 months, like the majority of people do. Once that client's in, you've got someone like ourselves overseeing things, doing monthly checks, but the business essentially runs itself, and you simply get either a monthly or a quarterly income on the back of this. The other type of lettings are, of course, where you can let in a very short period of time, like 1, 2, 3 day lettings. That's with our Skylet side of business. That's a bit more of manage that side of things. We have to manage that a little bit more closely. But again, it doesn't impact you. That's just us. We have to do a lot more work on the management side of things. And the only difference is reflected in the fees. So typically, if you want to let out a typical 12-month AST, you'll probably pay about 8% fees on that. That's 8% of your income. If you want to let out on the sort of Airbnb style lettings, you'll probably pay about 12% across the board. But again, it's something that once you've done that, once you've got all the setup done, which companies like ourselves, again, there are other companies out there that do it as well. But once you've got the setup done, you've got a business, and that's how you need to view it. It needs to be viewed as a business. Ensure you choose the right property. Now, I know this is obviously a basic idea, but you'd be surprised. A lot of people come to us with a certain amount of money, and what they do is they choose a property due to emotion, or they choose a property because they feel it's the one that's affordable to them. Just because it's affordable, or just because you emotionally like the pictures, doesn't make it a great property. We have a lot of people that come to us and they say, for example, I've got 180,000, and what they'll do is they'll say, right, I'll tell you what we'll do. Rather than buying one property in Manchester or one property in Liverpool, we'll go buy them 4 in the outskirts for 40, 50,000 each. That's not the thing to do. What they've not looked at is they think that they've spread their risk by having 4, but then when they've looked at occupancy rates, and by the time they've factored costs in to manage the 4, they're coming out with a really low net income. So what we do is we make sure that we choose the right property in the right area. So if there is a little recession, if there is a dip, we know that ours are going to stand the test of time. We look at what happens during a dip. Typically, the developments and the properties on the outskirts of the city fall first. Cities are last to go, but they are also the first to recover, because people still want to live in a city centre even during a downturn. And if it becomes more affordable, you've got higher occupancy rates as well. Again, this is what we've been through time and time again before. It seems like a never-ending subject, Brexit. So what about Brexit? What does it mean for you? What does it mean for the tenant? And what does it mean for your income? Well, look, it's one that, as I say, we ask constantly. The one answer that we give everyone across the board is the timing of any decision you make in terms of investment is never going to be perfect. Again, going back to the days when I was a graduate trainee in the stock market, we also had a lot of clients saying, oh, I want to get in at the bottom and out of the top. You will never get in at the bottom, and you will never get in out of the top. And ironically, you only know things are at the bottom after the event, and you only know things are at the top after the event. You don't know that you're in the bottom, and you don't know that you're in the top. So you have to basically judge this after the event. Prices are going to fluctuate. What we feel about Brexit, and we spoke to not just a couple of people in our close proximity, but all over Europe in regards to this, is we feel it's quite straightforward that things are going to plough on as normal. Pretty much, there's 3 ways that this is going to go. It's either a no deal, it's a deal, or potentially a second referendum. Regardless of which way things go, people still need to buy property. People still need to live in property. The advantage that everyone's got at the moment is due to Brexit, developers are holding prices. Rather than putting prices up, they're saying, do you know what, we'll hold prices, we'll keep firm. So it's actually a chance to buy. And do you know what? It's quite great, because developers, sometimes they're willing to take an offer to finish off a development. If they've got 50 units and it's sold 48, they may take a nice offer to finish off the last 2. Or vice versa, if they're just starting a development, they may take an offer to get the first 3, 4, 5 underway, which is what we're finding as well. So we still feel it's a great time to buy. I had a call yesterday with a client who said that after Brexit, they feel that things are going to really ramp up. and start to speed up again in the property market. So they're going to wait until then. And when we broke that sentence down, or that conversation down, we said, well, why are you going to wait until the prices go up? If you think it's going to ramp up in 3 months, why wait? It's best to buy now. So in regards to Brexit, we feel that market prices have already been heavily discounted. And like we say, developers are resisting so far increasing their prices. Across the UK, whatever way you look at it, you will see a lot of negative reports in the paper, but house prices are still going up. Are they going up as quick as they were 3-4 years ago? No, we know that. But the property market was at a low sort of 4 or 5 years ago. So we know that the prices aren't going to keep going up at that rapid rate, but they're still going up at a good, solid rate, better than most other investments out there. By the time you've taken on income and growth, you will probably still make the majority. You will probably still make more money, income and growth combined, more than the majority of other investment vehicles out there. Another thing that a lot of people don't take into consideration is, if we go around figures, if you've got £100,000 property and you've got £25,000 in cash, well, you can leverage. So if you've only got £25,000 in cash and you go and put that in the stock market, that's what you've got. You've got £25,000 in cash in the stock market. If you put it in a bond or a savings account, you've got £25,000 in that savings account. So any profit, any growth or income is going to be on £25,000. However, if you go and leverage that up in the property market, you put the same £25,000 in, but you've leveraged the other 75. Well, actually, your growth now is on your whole 100. You still only have 25,000, but you've actually got growth on £100,000 worth of property. You've got income on £100,000 worth of property. So actually, your income, in real terms, and your growth in real terms should be a lot higher, due to the fact that you've actually got it on a larger amount. And this is what a lot of people don't take into consideration. So again, with Brexit, we feel that the price is already factored in. Things are going to speed up after Brexit. So that's why we're saying now it's a good opportunity. Beat the rush. As soon as the March the 29th hits, if it is that D-Day when we leave, again, things will really start to push on. So we feel it's a great opportunity. Then we come on to, again, what about location? The majority of people over the years have all started in London. Again, even now we have a lot of inquiries for London, but they're now starting to get into their heads that actually London probably isn't the best time to buy. Wind forward a year or two, potentially London will be there because of the discounts that are there to be had. But at the moment, we've still got clients who are developers, I should say, who are still London based, and they're just holding firm on their prices. So they don't feel the need to discount as heavily as potentially what we're going to see in a couple of years' time. So we're still saying that the best cities over the last few years have proven to be Manchester, Liverpool, Leeds. And these are the cities that we feel are going to continue to do that. We still feel Liverpool, Leeds, Manchester, other cities. There's a couple of others there, like the Sheffields and Nottinghams and of the world and things like that, Birmingham as well. We still feel those cities are the key cities that are going to really outperform the market. If we look at the first two, Manchester and Liverpool, they did better in 2018. So if we go to 2018, the start, we had a lot of scaremongers saying the property market's going to fall. But actually, Manchester and Liverpool outperformed in 2018, outperformed what they did in 2017. So I think they grew on average about 6% in 2017. They did better than that last year. I don't think that they're going to keep increasing. I think probably 5 or 6% growth this year, probably 4 or 5% growth the year after. But that's fantastic growth. Add that onto your income, you're suddenly looking at double-digit returns. So the key thing about Manchester is it not only continues to drive itself forward with investment from its local government, but the business that's happening there at the moment in terms of the co-working spaces, in terms of the recruitment drive for the media companies. They've got new media university courses that are opening up, which is so a lot more students looking to go to the area. It's still one of the biggest student populations in Europe. And then the key is over 50% of the people, once they've graduated, remain in Manchester. That puts even more demand on the property market and increasingly increases the prices and your growth. Again, Liverpool, it's one of the fastest growing rental markets out there. It probably offers better returns than Manchester income-wise. My thing about Liverpool is that if there is a downturn, I feel that Manchester will be a little bit more solid But if you're simply looking for something over the 3 to 5 year period, pure income, then it's Liverpool. We've got projects out there at the moment which are on the Mersey, on the Wapping Dock, which are actually being done as an Airbnb let, and their prices start from about 160 up to 250, and they're making sort of anything upwards of £30,000 investment per year on the back of that. So clients are getting, that's gross. So clients are getting a phenomenal return on their money. And then Leeds as well. Channel 4 recently gone up there. So Leeds has got a fantastic contingent at the moment of young professionals. They've got Channel 4 got a new HQ being built in the city. So again, there's phenomenal opportunities to be had in Leeds. What we feel is if you look about half a mile to a mile outside of Leeds with good routes in, that's where you're going to have the key the key opportunities, because you're still a walk-in, or you're still a short bus ride or train or tram, or any other transportation they've got to go into the Leeds city centre. But the important side is that you can get heavy discounts out in the about half a mile out. Close links to the city centre, you'd be absolutely phenomenal. And then the last bit is, what do you do? Do you decide to go into a company or not? This is one that we're happy to look at with you, but this really depends on you speaking to a qualified accountant. We always say speak to a consultant, an expert, before committing, as everyone's circumstances are different. It's not a one-size-fits-all policy. The rules have been relaxed slightly to allow the shift to limited companies in terms of mortgages. So you can get mortgages in limited companies, where a few years ago it was a bit tougher. What we would say is if you have 4 or 5 properties now and you think, I'm going to change them over to limited companies, typically that's not a great way to go, because then you have to go and repay stamp duty. Little things like that have to be taken into consideration. Again, if you're looking to invest short term, then sometimes putting your company into a limited, or the property into a limited company, isn't always best. But we always say, again, speak to an expert, speak to your accountant. They'll give you the best guide about what to do and how to set up. And it's down to you to do some due diligence and run the numbers. Don't just run the numbers over the first 6 months, run the numbers over a 10-year period, what you'll get, because that's typically how long people hold their properties. Even though you think you may not, that's typically how long people to hold their properties. So then it comes down to, what are you looking for, income and growth? That typically is dependent on you. Only you can decide what you're actually looking for. Are you looking for pure income? Are you looking for growth? Typically, we say, look, a mixture of the two. The higher the income that you get, you should probably reinvest that income. It's wise. It's income that you may not have had anyway. So reinvest that income. And I've got no doubt that I've got clients who have never been huge earners, but they've just regularly reinvested, and they've now, 10 years down the line, they've now got a fantastic portfolio that they can never dream of. They've sold up, retired 5-6 years earlier than they thought they were going to, and they've got a great portfolio. Timing has helped for them, of course, but if you keep reinvesting and leveraging as best as possible, there's some great opportunities to be had. Again, what we say is decide beforehand, but a blend of both is ideal. Most importantly, a lot of clients sometimes try and squeeze so much out of the deal because they feel that that's best for income and growth. They've got no breathing space between their returns and their costs, that if they do ever have a dip, let's say, for example, it's not rented for 6 weeks, even 4 weeks, things are too tight for them. So what we do is we tend to look at figures with our clients. We won't allow you to, squeeze the maximum out. And we say, and then we'll do a stress test. We'll say, right, what if it isn't rented for a month? Can you afford it? What if it isn't rented for 3 months? Can you afford it? And then we'll go ridiculous. What if it isn't rented for 6 months? Can you afford it? If the answer is yes to all of those, we'll tend to allow you to move on. But what we say to everyone is allow enough cost, because although that we have got fantastic occupancy rates, we've got late 90s in terms of occupancy rates for our ASTs, for our 12-month tenancies, and over 60% for our Airbnb style tenancies. We know that if things do change, or if things adapt, or rules change, we need to make sure that you've got breathing space between your costs and returns. So that's a key point. And again, like we said, taking income from the business is not something that you should keep looking to do. It shouldn't be a pot that you keep taking income out and that's it. I would say if you're looking to build up a long-term plan, regenerate. So keep that income into the business and keep reinvesting. That gives you far greater attraction over 10 years of building up a phenomenal business rather than something short term. So any questions, guys? I believe you guys should have a speech mark or speech mark bubble. And any questions? We've got a couple here so far. Let's have a look. Manchester versus Liverpool. So Manchester, what is your opinion? Again, Manchester's more expensive than Liverpool. So first of all, it comes down to budget. Manchester is, one of those who hit the ground running a little bit sooner than Liverpool did. So Manchester is more expensive. Liverpool will catch up. And Liverpool is better income at the moment. Just again, simply a bit like London's expensive with low yield. Manchester will eventually become that over the years. I think that we'll probably see the Manchester yield falling to what London is. If you buy now, it won't be affected. But for those who are looking in 3 or 4 years in Manchester, I feel that your yield is probably going to be 3.5%, just simply because the rent can't keep up with the property prices. So that's why Liverpool at the moment is generating the most amount of income. In terms of, again, the safety side, I still feel Manchester has one up on Liverpool, because I feel that Manchester is just has a bit more substance in regards to the companies that are there and in terms of the things that are going on there. But you've got phenomenal short-term lets in Liverpool. What I'm looking at the moment are the short-term sort of Airbnb style lets on Liverpool, because you can get great projects which are, as I say, right on the Mersey, let them out like hotel rooms. They're making probably 10% plus net, that is as well. So quite comfortably, already with a proven track record. So we've got developments there at the moment with already a proven track record, which can be let out like that. So there's plenty of opportunities. But as I say, overall, it really does. They're close run, but it does depend on the person. Difference between AST and short term. Okay, so the AST is typically classed as what's called like a 12-month rent, 12-month let. That's your typical, you rent it out 12 months, you either get new tenants in or you re-sign your initial tenants that are already in. With the extreme short-term lets, like the Airbnb, typically there is more money to be made. With that, you can get double-digit returns quite comfortably. However, there's a lot more of management to do. So you've got a lot more management to do. There's a lot more work to do. With little things like you want to make sure that the prices are right for the actual days that there's an event on. So, for example, if there's an event on, at the Echo Arena, for example, you want to make sure that the price is adapted to that. Therefore, what you can then do is you can up your price on those days, lower the prices on other days. For example, with Liverpool playing at home in a Champions League game, you can increase your prices on those days. So it needs a lot more work, but again, fantastic potential. And Liverpool's probably one of the best places to do that for. Again, Manchester's phenomenal as well, because you've got 2 great football teams. You've got loads of stuff going on in regards to concerts. You've got obviously cricket ground. But again, Liverpool equally as good. You've got Liverpool. You've got 2 football teams there. You've got Echo Arena. So as long as you get the right location, great potential. Great potential. Another one here. Buy-to-let tax exemption rules changing over the next few years. Do you think this will be sped up over Brexit? No, they've kind of put the rules in terms of, and I'm going to clarify what you mean by this. Tax exemption rules. Are you talking about your initial tax bracket that you get available? For example, are you talking about your initial 11,800 that you get available for income? If that's what you are talking about, then again, I can't comment on what's going to change in the future after Brexit. What I can say is that at the moment, EU or non-EU clients are entitled to an initial 11,800, I believe it is at the time of speaking, 11,800 tax-free income. They have to fill in what's called an NRL1 form. That's a non-resident landlord 1 form. So this doesn't actually change. Doesn't matter whether you're in the EU or out of the EU. So if you're overseas and you're buying something in the UK, we always say, look, as soon as you've exchanged or completed, get an NRL1 form, which again, this is stuff that we will help with. Complete that form, and then rather than being taxed at source at a certain percentage, you can then be taxed. You can do a tax return, and if you earn under a certain limit, again, it will be tax exempt. I think that's the question you're asking. Apologies if it isn't. Well, look, any other questions you got, feel free to email directly. This will be recorded and put onto our website within the next 24 hours. And as I say, from me, have a lovely rest of the month, or a lovely rest of the week, and I look forward to speaking to you next month. Take care.